Apple is scheduled to report quarterly financial results after the markets close on Thursday, January 30th, 2025. That has investors curious, should they buy Apple stock before the company announces earnings? I'll answer that question in this video, as well as preview what investors should look for from Apple when it reports quarterly results. Let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
In its latest quarter that ended September 28, 2024, Apple reported total net sales of $94.9 billion, which was up by more than $5 billion from the $89 billion it reported in the same quarter last year. In the 12 months that ended September 28th, Apple's revenues jumped to $391 billion, up from $383 billion in the same time the prior year, demonstrating Apple's giant revenue total. It's among the businesses with the most revenue in the world, coming behind companies like Amazon and Walmart, which are approaching total trailing 12-month revenues of $700 billion. Apple's gross margin increased by over $3 billion to $43.9 billion, up from $40 billion. That's a result of its services business growing faster than its products business. And you can see here when you compare the product sales and the product cost of sales with the services sales and the services cost of sales, why that expands the company's margin. The company's services business is more than twice as profitable as the products business. And intuitively, that makes sense, right? When you're selling things like iPhones, there's a lot of materials and labor that goes into each incremental phone. But when you're selling a service like Apple Music, there isn't as much incremental cost that goes into each sale. You've already paid for some of the rights, and maybe an additional subscriber would increase the fees that you have to pay for music rights. It's not as much as the cost you have to pay for the materials to make a new iPhone. Similarly, if you think about Apple TV Plus, the company's already paid for the content it created to put on the TV streaming app, and an incremental subscriber doesn't add very much to its cost. And so services sales are much more profitable for Apple than product sales. But Apple needs product sales so that it can generate services sales, because you're more likely to subscribe to Apple Music or Apple TV Plus if you own an iPhone, or if you own an Apple Watch, or if you own Apple AirPods. And so those two businesses are linked, with one being more profitable than the other. Still, other businesses that operate on a similar business model would be envious to have the kind of margins that Apple has. Other businesses that operate on this kind of model, where they sell you a product and then they also sell services that you can use with your product, they would be happy to sell the product at cost, no profit, just to get you into the ecosystem so they can sell you services. Apple manages a healthy profit margin on its products and a lucrative profit margin on its services. That's what's made Apple one of the biggest businesses in the world when measured by revenue, profit, cash flow, market capitalization, and I could go on. Its operating income also increased to $29.6 billion, up from $26.9 billion. And for the trailing 12 months, it increased to $123 billion, up from $114 billion. All right, now that we've talked about the positives about Apple's business, let's talk about the risks. And the greatest risk right now is the business in Greater China. In the latest quarter, sales were flat at $15 billion compared to the same quarter last year, $15 billion. Over the trailing 12-month period, Apple's sales in China were down to $66.9 billion, down from $72.5 billion in the same 12 months last year. Now, in the last 3 months, all of the reports I've been reading coming out of smartphone sales in China are that Apple is losing market share hugely in that region. I'm talking market share declines of 20 or 30% in the latest 3 months in China. Furthermore, the incoming administration in the United States is threatening increasing tariffs on China, and given that Apple's manufacturing supply base is centered in China, the risks are elevated. Apple was successful the last time around in negotiating exclusions of its products on tariffs. Will they be successful this time around? That remains to be seen. In any case, the CEO, Tim Cook, has done a phenomenal job leading the company and was successful in negotiating exclusions in the prior time President-elect Trump imposed tariffs on China. Still, investors are not happy about the already declining market share in China, and then you have the extra risk from the incoming administration. Now, another risk for Apple is its reliance on the iPhone. In the latest quarter, the company generated total net sales of $95 billion, $46 billion of which was iPhone sales. And I would argue that it's even more significant than what this shows because, as I mentioned earlier, if you don't have an iPhone, you're probably not going to subscribe to Apple Music and Apple TV Plus and the search engine revenue that Apple generates from its relationship with Alphabet when you use your iPhone for search. All of that would be decreased or non-existent if Apple didn't sell you an iPhone. To make matters worse, if you don't have an iPhone, you're probably not going to buy an Apple Watch or the AirPods or accessories or Apple insurance, the Apple Care. And so the iPhone is a critical part of Apple's business. And if there should be a competitor that manages to take some market share away from Apple, it could be devastating for the business. Already, we're seeing it lose market share in the smartphone segment in China. So we're already seeing that. And Apple's business is an international business, as you see there. Only 41 billion of its total net sales were from the United States or from North America. And so the rest of the business is international. And if a local player can take market share away from Apple in China, what's to stop another local player in another region from taking market share away from Apple there? Apple's now trading at a forward price to earnings of 28, which I've argued is a little bit rich given the company's prospects in the incoming year, in the incoming few years. Furthermore, my discounted cash flow valuation model suggests an intrinsic value per share for Apple of $161. The current market price is $230. Given the elevated risks and the elevated valuation, I downgraded Apple stock this year. On January 1st, I told investors that Apple stock, I would rate it as a hold from this point onward. I had it rated as a buy last year, and to start this year, I rated it as a hold. I downgraded it. So to answer the question, should you buy this stock before earnings? I would say no. I would say this is one of those businesses where the valuation is stretched and the risks are higher. I think it would be more prudent to wait for the company to announce the earnings, digest the results, and then make a decision afterwards. Of course, I'll share with you the details of the company's latest earnings release and the big takeaways from those numbers. And if there should be a change in my rating from Apple's earnings release, if they were to provide numbers that are so strong that it warrants an upgrade, of course, I'll let you know in my videos and in my analysis afterwards. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.